Great. Today we will discuss chapter 14, which is, by the way, the last chapter that we will review for the course. This chapter discusses the investment banking, insurance, as well as mutual funds, key products and services that are offered by financial institutions, primarily for the purpose of increasing fee income. We'll talk about why the search for fee income. We'll discuss the different products and services. And we will also discuss the product line diversification and what is known as economy of scale and economy of scope. As we have discussed in the past, we all are aware that financial institutions are going through a difficult time trying to generate revenues from interest income to supplement lower interest income for several reasons, primarily interstate banking laws, which has increased competition, Bank Modernization Act, Gramm-Leach-Bliley Act 1999, that further increased competition. All these financial institutions are trying to find other sources of income, and fee income appears to be the major source. Fee income for financial institutions has grown from about 10% in the 1980s to roughly 30% today. Up until 2013, fee income was rising gradually on an aggregate basis for the institutions. 2013 was the first year where fee income has now stabilized, as financial institutions are now well equipped to offer the products and services. So the growth in fee income has pretty much become stable. Why do they want to generate fee income? One is to supplement traditional sources of funds, such as deposits, by offering insurance products, investment banking, mutual funds. They can increase the product line, at the same time increase fee income. By offering more products, they can generate lower unit cost, which we call economy of scope. We studied this in chapter 3. By offering more products and services, they are passing on and offsetting some of the costs and passing on this cost to the customers. Again, by offering major different products, diversified products, they are able to reduce their overall risk. If there is no demand for loans, perhaps there is demand for insurance, investment banking services, and so forth. If deposits are difficult to generate, perhaps funds can be generated by offering mutual funds. And then institutions want to promote cross-selling by offering more products to the same customers. When customers go to a branch today at a bank, quite often the teller at the branch asks the customer, could we offer you insurance products, mutual funds, trust services? So this is the way that they cross-sell products and services today, again to increase revenues. Let's first discuss investment banking services. We will then move on to mutual funds, trust services, and then we will discuss insurance products as well. Investment banking services is one of the largest sources of income for financial institutions other than loan and deposits. Investment banking services are not for all banks. They are for the largest multinational institutions across the world. What are the key investment banking services they offer? Remember, please, they're offering these primarily to generate fee income, not interest income. One is IPOs. Up until 1999, initial public offerings could only be offered as a product by investment banks such as Merrill Lynch, Morgan Stanley, Goldman Sachs, etc. Today, any of the financial institutions that you see here, including many, many more, could offer investment banking services. Leverage buyouts. Dell Computers is a good example. Michael Dell decided to buy out the companies and buy out all the shares owned by the public to take the company private. When a corporation is taken private from being a publicly held company, it is known as a leverage buyouts. Why do we call leverage buyouts? It's because of the fact that the owners of the new company will need to borrow money to pay off the shareholders. And therefore, by borrowing more money from the banks or whatever other methods, they are leveraging the corporation. Many of the investment banks, as well as commercial banks and insurance companies such as AIG, Metropolitan Life Insurance Companies, they have all gone into mutual funds and hedge fund business. Within the investment banking services, corporations that look for these services from financial institutions have certain questions that they want to ask them. Should we raise new capital? Should we issue new shares of stocks or bonds? Or a combination of both? What should the stock price be? Especially in the case of an IPO. How many shares of stock? How many bonds should we issue? Who should we be our target market? 2, should our company enter into new markets, domestically as well as internationally? Does our company need to acquire or merge with other firms? Mergers and acquisitions is a major source of revenue for all institutions that are involved in investment banking services. And should we sell our company to another firm if that's what they want to do? Again, being a company being acquired. As you know, in 1999, the Bank Modernization Act, which is called the Gramm-Leach-Bliley Act, increased competition among banks and non-bank service companies. Investment banking revenues has increased in certain years dramatically. In some years, investment banking service revenues has dropped, such as in the financial crisis in 2008, 2009, 2010. So therefore, there are individuals who are not quite sure and not quite clear whether or not investment banking service is really a benefit or a detriment to those institutions that never used to offer that, but now they do. Have they increased the risk? Only time will tell. Investment banks today are still wrestling with questions. What products and services should they offer to generate the highest revenues and profitability? We find today the fact that the largest investment banks, such as Morgan Stanley, Goldman Sachs, JP Morgan Chase, these institutions are doing less and less investments on behalf of clients in stocks and bonds. Means personal advice, financial advice. They're doing less and less financial advice to individuals. Why? Because of the fact that many commercial banks are competing against them. And commercial banks have branches And they have the customer base, which are their loan and deposit customer base. So to offset reduction of financial service advice, these large investment banks, such as Morgan Stanley, are now offering more and more in initial public offerings, leverage buyouts, offerings, issuing new shares of stocks and bonds for corporations, issuing bonds for government agencies, and so forth. This is where they find that the revenues and the profits are the highest, rather than in offering personal advice. Commercial banks and investment banking combinations. Many of the largest commercial banks began to offer investment banking. Citi, Bank of America, J.P. Morgan, etc. Yes, there was some promise, the fact that these institutions will begin to generate large profits and increase the revenues. And they did from 1999 up until 2007. And because of the mortgage market meltdown, which is a financial crisis, these same institutions lost a lot of money, including commercial banks. Today, Merrill Lynch is no longer an investment bank acquired by Bank of America. Lehman Brothers was acquired by Barclays Bank. And we had one more institution, Bear Stearns, was acquired by J.P. Morgan Chase. Many of the commercial banks failed during the crisis, primarily because of the investment banking services. So therefore, questions arise whether or not they should ever been allowed to offer these services. But it is not being changed, by the way. They still offer those. Let's talk about the next product line. Within the investment banking service product line, we have mutual funds. Mutual funds, by the way, are designed to offer investment opportunities in stocks and bonds to individuals like you and I, who otherwise will not be able to invest unless you have significant amount of investment funds. What mutual funds do is that they would pool the funds of individuals by pulling smaller denominations invested by each individual as low as $25. They can now combine the funds, use those funds to buy stocks and bonds and other securities on behalf of the individuals. Therefore, each shareholder will receive a pro rata share of the stocks, bonds, and the dividends earned on that, as well as the increase or the decrease in return. Returns could be positive or negative. All of those are shared pro rata based upon how much is invested by you versus me, and how many shares you own versus how many shares I own. The value of our investment in a mutual fund, when we liquidate it, is determined based upon what is known as a net asset value. Net asset value is the value of all stocks and bonds on a given day, aggregated, divide by the number of shares that are outstanding. Remember, these shares are owned by individuals, small investors. They take the actual value of the stocks, bonds on a given day, typically when the market closes at 4 p.m. They will take the aggregate values of these securities, divide by number of shares, minus any liabilities, which are any borrowings by the mutual funds. The difference between the asset values, the values of the investments, and the liabilities becomes the net asset value. That net asset value is divided by number of shares outstanding. If you own 50 shares, when you liquidate your mutual fund, you will earn 50 shares times the value of the net asset value per share, which is difference between the value of the stocks and bonds minus the liabilities. The investment amount that you have that is liquidated is provided to you at the end of the business day. Please keep in mind, mutual funds are not allowed to day trade. Means they cannot trade during the day. Neither can you and I if we have mutual funds. You can do day trading and intraday trading if you decide to invest yourself without the help of the mutual funds in stocks and bonds. But once you invest through a mutual fund, you can only liquidate your assets at the end of the day based upon the net asset value of the investments when the market closes at 4 p.m. That is a restriction. And the reason why the restriction is there is because mutual funds are typically investments made by investors like you and I. Regulators do not want us to use mutual funds to do intraday trading, which is rather risky. Regulators want us to use mutual funds so that we can grow our investments over a long period of time. And a lot of the mutual funds are invested in retirement products. Today, the mutual fund industry is about $12 trillion. So if you take the aggregate of all the mutual funds across the world, and there are thousands and thousands of mutual funds, when you aggregate the value of the stocks and bonds and securities they have invested in on your behalf and my behalf, it is equal to $12 trillion. The largest investments of any type of product. Majority of these are individuals like you and I. And a majority of these are retirement funds, which should be set aside and not allowed to play the stock market. That's why regulators prohibit intraday trading. How do banks promote mutual funds? Today, banks promote mutual funds based upon what is known as a proprietary or a non-proprietary. Bank of America, J.P. Morgan Chase, Citi, HSBC, M&T Bank, KeyBank, all of these banks have their own mutual funds under their own name. But they also offer mutual funds that are offered by other large mutual funds. Example of large mutual funds that are non-banks, we call it the non-proprietary, are Fidelity, Vanguard, Janus, PIMCO, the Principal Fund. We have also the American funds, Templeton, Franklin Templeton funds. There are thousands and thousands of these funds. The 25 largest mutual funds have 75% of the investments on behalf of the individuals. So there are 25 out of thousands of mutual funds that are as large as the gross national product of many of the smaller countries. So they are quite large. Banks offer these funds. If they offer non-proprietary funds, they get fee income. If they sell proprietary funds, those funds are retained by the bank as an alternative to deposits. Remember in chapter 12, we talked about the fact that deposits the share of deposits is shrinking. Our grandparents invested 90% of their wealth in deposits. Individuals like you and I would only invest 10% of the deposits and 90% in mutual funds or stocks and bonds. So this is a good source for the banks to generate funds because of the lack of deposits. Let's talk about annuities. The next investment product, annuities are primarily long-term deposits. They act as time deposits. However, they could be invested in stocks and bonds. So the difference is that annuities do not provide FDIC insurance. So they are not guaranteed. Deposits are guaranteed by the FDIC up to $250,000. Annuities are a hedge against living too long and outlasting one's savings. Most of the annuities are purchased by individuals who are 50 years old or older because they don't want to invest in stocks, bonds, and they are looking for a fixed return for a longer period of time, whereby these individuals will invest a lump sum. The minimum is $50,000 deposited, invested today in an annuity, earning a fixed return. Or they can purchase a variable annuity where the returns will be different. And these annuities are typically 5 years or 10-year annuity. So they mature in 5 or 10 years. Variable rate annuities invest in stocks, bonds, and mutual funds, and therefore the return varies. They could be higher or lower, or it could be negative. Fixed rate offer a lower rate, but it's a guaranteed fixed rate for the term. So these annuities have become a good investment tool primarily for the elderly. And financial services are able to generate substantial annual fees. Please note that investment products, including annuities, they are not insured by FDIC. They are not a deposit. There is no guarantee of return unless it's a fixed annuity, fixed rate annuity, and they could be subject to investment risk, particularly if they are invested in variable rate annuities in stocks, bonds, and mutual funds. Next, let's talk about trust services, please. So far, the products that we have talked about are investment banking, mutual funds, and annuities. Please keep in mind that annuities investment, by the way, this is very important. It's a question that could be asked in the exam. Annuity investment products are typically offered by banks and insurance companies. Investment banks such as Morgan Stanley or Goldman Sachs would not offer annuity products, mainly because of the fact that they are individual investments. They try to promote more corporate institutional investors rather than individual. So annuities products are typically limited to banks and insurance companies. Trust. Trust services is another source of fee income. Trust services have been offered by banks, mostly large banks, for over 200 years. Today, trust services are only offered by banks. No other institution offers them, not because they're not allowed to, but they're so specialized that they don't have the ability to have experienced individuals to offer trust services. So please note, they're only offered by banks. There are different kinds of trusts. Trusts are typically offered to very, very old individuals. For example, you could have grandparents who have a wealth of investments. They have investments in real estate, deposit products, insurance, etc. They're very wealthy. They have children and grandchildren. What they are concerned about is that when they die, who is going to get their wealth? Real estate, insurance, deposits, investments. So what these grandparents would do is go to a bank and look for a trust officer at a bank. Why do we call them trust officers? Because for the longest time, and I can speak for myself, of course, this is the truth. For the longest time, bankers were the most trusted individuals. Today, many of you probably disagree with that, especially because of the financial crisis. So today it's changed. But many, many years ago, they were the most trusted individuals. People deposited money in banks because they trusted the banks. That's why the term trust came about. And that's why banks are typically the only ones that offer that. So these grandparents will go to a trust officer. They will provide all the information about their assets. And they will designate who should receive proportionally the assets when they die. Typically, if the assets are left to the grandchildren, the grandchild must be at least 21 years old before he or she will get his or her share. No earlier than that. That's the rule. So this allows them to pass on their assets without difficulty. If they don't have trust services, once the grandparents die, their children will fight for the wealth. And they don't want that to happen, so they designate ahead of time. Let's talk about a couple of these trust services. Living trust. What this means is that once the grandparents determine who will receive their wealth, they have the right to change that proportion and change their mind about how much will each person get while they're still alive, while they're still living. So living trust means that this allows the individuals to change the proportion of their wealth going to different individuals, children or grandparents, or grandchildren rather. Irrevocable trust is just the opposite. Irrevocable means that they cannot change their mind. Once they sign who will receive the wealth, they cannot change their mind even when they're alive. That's the difference between living and irrevocable trust. Let's talk about charitable trust. We know that many of the wealthy individuals, Microsoft, the owners of Microsoft, the most wealthiest individual, have set aside some of their wealth to charities. What they've done is they've said that when they die, this trust officer will take a portion of their wealth and provide that to the charity of their choice, which they have already designated. Whether it is to help children in Africa, whether it is to cure HIV, whether it is to cure cancer, So any charity they choose. And what will happen is that that proportion of their wealth when they die will go to those charities. And the rest of the funds will be shared among their children and grandchildren. Let's talk about insurance products. This is the last of the products that we will discuss. Insurance products is another source of fee income for all financial institutions, particularly banks, beginning 1999. Today, banks can compete against Progressive Insurance for auto insurance or Geico Insurance. Banks can offer life insurance policies and compete against Metropolitan Life Insurance, Prudential Life Insurance, AIG Insurance. They can offer property insurance, compete against Geico or Progressive. They also offer casualty insurance. Let's talk about what these products are. Please keep in mind the fact that you could take a whole semester discussing about insurance products. My objective is just to give you a brief understanding of how financial institutions profit from these types of services, primarily fee income. Life insurance and property casualty insurance involves two types of services: underwriting and sales. We'll talk about that as well. What is underwriting and what is sales? Please keep in mind the fact that insurance products, this is a very good slide for me to ask you a multiple choice question, slide 15. Insurance products or an annuity are neither of these are deposit products. We talked about annuities earlier. They are not insured by FDIC. They could result in investment risk. Why? Because insurance companies and banks who offer these products, in order for them to provide benefits against insurance, they need to find a way to invest the premiums or fees that are paid by customers. Premiums are your periodic fee that you pay for the policy. They take those premiums or fees, and roughly 60 to 70% of that premium or fee is invested in stocks and bonds. They are allowed to invest in stocks and bonds, corporate bonds, as well as government bonds. That causes investment risk. The returns from the bonds provide the benefits. The rest of the funds are used for operating expenses, salaries, etc. So, they are not a deposit, they are not insured by FDIC, they do involve investment risk. And finally, banks, which are US depository institutions, cannot give you a loan just because you have an insurance policy with them. If they want to give you a loan, it has to be separate from the insurance. What are the benefits? Well, let me step back for a second, please. Let me just cover the underwriting versus sales. Underwriting of insurance, I'm going to be back to slide 14, please. Underwriting involves making a decision to whether or not the customer should be provided the insurance, or does the customer qualify for the insurance. Basically, underwriting is qualifying the customer. To qualify for insurance for you and I, we must have a very good credit score. Why? Because you have to pay premiums or fees for the policy. So that's why they they check your credit score, and underwriting is part of the process. Many of the insurance companies are doing underwriting online. Again, one good example is Geico. Geico's commercial says, if you have 15 minutes, we can save you 15% on your insurance. Now, what do they mean by if you have 15 minutes? What that means is that you can go to geico.com, you can fill out the paperwork, a form, and submit that. By doing that, you are doing the underwriting for Geico. You are saving them substantial amount of time, and therefore they will give you a 15% savings on your insurance. Many insurance companies today still handle underwriting by meeting with an individual, with an officer, insurance officer. But more and more insurance companies are underwriting online. Sales, insurance sales is where they would actually promote insurance products. Again, as I mentioned to you before, if you go to a bank, if you go to a teller, at times the teller will ask you a question. Could we offer you life insurance? Do you own an automobile? Could we offer you insurance policies? We would like to offer you more products, relationship pricing. By doing so, banks are increasing fee income, and they are passing on the unit cost to more customers, thereby reducing their overall expenses. So, what are the benefits? Just to summarize, we have talked about investment banking. We have covered mutual funds, annuities, trust services, and insurance products. 5. The benefits are diversification. Generally, when financial institutions consolidate, they make sure that they consolidate with some level of convergence. What that means is that the two businesses strategically are able to benefit from each other. They can cross-sell those same products to another customer. So when they do mergers and acquisitions and consolidation, that's what they look for. So diversification provides more income from the same customers, stabilizes cash flows and profitabilities, and reduces expenses. I'd like to give you one quick example of how HSBC Bank has benefited from Chapter 14. HSBC's customers are some of the most wealthy customers in Beverly Hills, California. Mel Gibson, the actor, Steven Spielberg, the director, Sean Connery, the actor in London, and the names go on and on and on. These individuals, by the way, all have accounts at HSBC Bank, either in London or Beverly Hills. They are billionaires, of course. Now, when Mel Gibson produced his movies, The Patriot, and some of the movies that have been classical movies, not anymore because he has some personal problems now, but in the past he used to make very good movies. All those movies were financed by HSBC Bank. They gave them the loan. When Steven Spielberg production, his production is called DreamWorks, DreamWorks. You may have seen movies where the movie starts out with a half moon, and there is a little boy with a fishing pole. That's Steven Spielberg. All those movies are financed by HSBC Bank. All very profitable movies. Okay. When Steven Spielberg wanted to sell his company to Walt Disney 5 years ago, he would have typically gone to Goldman Sachs to do the consolidation, mergers and acquisition. However, because Steven Spielberg is a customer of HSBC Bank, he came to us and said, look, you have all my business, you know me very well, you have all my documents, could you help us? HSBC made millions and millions of dollars from this one transaction, which otherwise they would not have been able to do so. This is an example of diversification. This is, by the way, this example is just a mathematical example. I'll show you the example that is in the coming up in terms of how we determine the overall profitability. In order to determine what is the benefit of diversifying products and services, banks typically calculate the overall returns from different products. They look at the revenue from traditional services, TS, loans and deposits. They look at the returns from other traditional services, and they return from that. So the amount of investments in loans and deposits times the return. And the proportion of revenues from non-traditional services such as investment banking, mutual funds, insurance business, and so forth, times the return. When we take the proportional weighted average, we are able to get the expected return based upon these services. So in this example, which is the example on the previous page, please, 80% of the revenue is from traditional loan and deposit services, generating 12% return. And remaining 20% is from non-traditional banking services, generating 20% return. And therefore, the overall return is 13.6. We do the same thing with regard to risk. In the previous slide, we looked at the return. Risk is a function of standard deviation. We look at the risk associated with investing with certain non-banking services and the risk associated with the traditional banking services. How much is invested in each, and we determine the weighted average risk as well. Diversification reduces the overall risk because some services are more risky than others. And this is an example. Please keep in mind that you will not be asked in the exam any of these calculations. These are just for illustration purposes, so you can understand how banks and other financial institutions determine the overall return and overall risk. So none of these formulas will be required. We also do the same thing with regard to overall production cost. What is the overall cost from producing product A and product B? How much is invested in product A and product B? And we take the overall totals. Finally, these services emerged as a result of the 1999 Bank Modernization Act. Institutions could decide to offer them. They could decide not to offer them. It's up to them. As a result of this, because of the fact that quite a bit of information about you and I is now housed at a bank or any financial service company, they are required to protect our privacy. Means they are not allowed to provide our information to anyone else and benefit from cross-selling products and services. Every year, financial institutions, including banks, are required to send you a letter in the mail, not by email, by mail, postal mail, asking you, could they share your information with their subsidiaries? What do we mean by subsidiaries? Please keep in mind, subsidiaries are non-traditional services. So if the bank is offering investment banking, insurance products, mutual funds, these are their own subsidiaries. They're asking whether or not they can share your information within the institution, not outside the institution, with their subsidiaries. So they can then contact you if you're interested in buying insurance or any financial services products. Please, if you don't want them to do that, you need to contact the 800 number on the letter and inform them. If you don't call them, that means the fact that they are allowed to provide your information to those customers, to their subsidiaries. Okay. That concludes chapter number 14. This chapter does not have any problems or questions assigned at the end of the chapter. Please review the chapter very carefully. In the final exam, you will be asked questions from chapters number 12, 14, and 15. This is one of the chapters. Chapter 14 will only be multiple choice, not problems. However, chapters 12 and 15 will have both multiple choice and quantitative problems. So out of the 3 chapters in the final exam, 2 will have problems, quantitative problems. All 3 will have multiple choice, including chapter 14. That concludes the lecture. Thank you very much.